What's going on, guys? Welcome into your Energy News Beat here on this gorgeous Friday, January 22nd, 2021. As always, I am your humble correspondent, Michael Tanner, coming to you from an undisclosed location here in Denver, Colorado, joined by my executive producer of the show, the purveyor of the show, and the director and publisher of the world's greatest website, EnergyNewsBeat.com, Stuart Turley. How you doing today?
It's a beautiful day in the neighborhood, and we have a hall pass to hand out.
We have a hall pass to you guys, and we also are starting a new Friday segment with none other than Hot Take of the Day Master David Ramsden Wood, otherwise known as DRW. You can check that segment out. At the end, we recorded it this morning, so I'll just go ahead and splice it in here. It's a great show, or a great segment. Highly recommend sticking around for the end. We have a great show, as you can see to my left. Rig count, storage numbers on both crude oil and natural gas. Stu's busy on the international news. We'll get to all of that, but first, guys, just subscribe to the Energy News Beat in a couple ways. Subscribe to this YouTube channel. Do what all those 16-year YouTubers say. Smash that like button. We really appreciate it. Hit that pesky subscribe or notifications button. You'll never miss an episode. Also, on our homepage, just subscribe to our one-click notifications. The best way to stay updated on all of your breaking energy news, whether it's EV, whether it's earnings, which we'll cover for Schlumberger, whether it's we're on the blue hydrogen section, whether we're talking about new M&A action in the DJ. We have it all. The best way to stay up to date is by subscribing to the one-click notifications via the world's greatest website, EnergyNewsBeat.com. Moving over into the markets, I'll just give you the high-level numbers right now. SPY about 1/10 of a percentage point on the downside. Coming in at 38.46. Nasdaq was down 0.3 of a percentage point. Dow Jones down 0.2 of a percentage point. All off relative all-time highs. It's been a pretty bull week, a little of a pullback. Why are some of these numbers offline? Well, remember it's earnings season, guys. So Dow component, large component, IBM, fell 9% after they reported fourth quarter sales below analyst expectations. Revenues also fell 6% on an annualized basis, and it was the fourth consecutive quarter of declines for IBM. That's going to drag down the Dow component. Intel shares, which is our big Nasdaq component, actually fell 7% after they retreated 6% on Thursday. So that's going to pull some things around. On the stimulus side of it, remember, $1.9 trillion is what new President Joe Biden is hoping for a U.S. stimulus plan. He's getting pushback now from Senator Joe Manchin, who thinks the $1,400 proposed direct payments is too much. So will stimulus get hold up? Remember, the market's already priced that in. We're at all-time highs. We've priced in the fact that this new stimulus is coming. If it does not come in time or it's delayed, we're going to get into the issue that happened, what was it, 3-4 months ago, Stu? What did I show up to the show every day and say? We're just waiting on stimulus, baby. It's just stimulus time. So not that means I'm for or against the stimulus. It just means the market's priced this in. And if you want to continue to see all-time highs, we can see the markets go up, which clearly the Fed wants to do. You got to probably, it's just, I was thinking of this conversation I had with my dad last night, and it was just, talking about, how the U.S., the money supply and all that, and there's a lot of money floating around. The point is, the more money that continues to flow in, the higher these markets will continue to go. Let's move over to the crude oil side. And look at those numbers. Oh, I'd be remiss to say Bitcoin, after being down 8% yesterday, up 6%. Talk about the roller coaster if you're a Bitcoin investor. Holy smokes. Crude oil now down 1.3 percentage points, 52.42. That was off a build in petroleum stocks, which we'll cover here right after. Back end of the curve down 1.2 percentage points. Natural gas stocks came out today. Nice draw, but not quite as well. Remember, the weather trade is still in effect right now. That's down 1.21 percentage points. The note out of and one of my favorite guys, James Hershavak, who writes for FX Empire, really what it looks like is, quote here, NGI wrote, forecasters continue to reflect a solid surge of cold next week, though freezing temperatures are now not expected to extend as far as previously thought or last long. The problem is traders look 10 to 15 days ahead on the natural gas side for weather, so that's what's happening. They expect cold weather to be coming in. It's just not in that time frame to fix. So that's why you're seeing a slight drawdown. We also saw a 187 billion cubic feet draw. That was lower than analysts' expectations at 197 BCF for natural gas stocks. So part of the reason why you when you look at that, you're seeing natural gas down as heavy. Back end of the curve, $2.81. It was only down 0.4 percentage points. So that front month, just getting pounded. XOP, which is the E&P securities contract, it's half of a percentage point on the downside. OIH didn't fare much better, 3/4 of a percentage point, currently trading 167.65. Biggest movers on the downside, Contango down 5 percentage points. Natural Resources LP down 6.5. Phoenix Minerals down 7. Chinook, no, they could be no longer listed here. No joke. They're down 8 percentage points, and down at 9.5 percentage points. Tensico Gas on the upside. Couple things here. SM, they're up 6 percentage points. CDIV, they're up 9.7 percentage points, and Telrinian Midstream Company, they're up 14.8 off the back of getting a new project over in Oklahoma City approved. Stu, it's another busy international news desk day. What do you got for us?
Now, we got some entertainment, and I'm holding that story for the end there. But first up, we have Iran starts ramping up oil production for pre-sanctions. This is kind of crazy. Iran and Iraq are driving the poor leadership at OPEC nuts. Iran has started ramping up its oil production and expects to reach pre-sanction levels in 1 or 2 months. That's not including all the other stuff that they're trying to get to. They're going to get to 4 million barrels per day. That's almost 1 million over what they were doing in December. So holy smokes, buckle up. I don't know how the world is going to have the oil.
And that's, it's something where's the demand coming from? I don't know.
It's not. So, okay, here we are. You ready for this one? This is between Iran and Iraq and India. Iraq cuts crude oil supplies for most of the Indian refiners. Where this is going is they're taking their heavy crude to China. I got another story on that here in a second. But Iraq was the top oil supplier to India in 22, and they have heavy crude. And of that, we never expected Iraq to cut our volumes. We may have to look to alternatives like tapping on the spot markets, meaning Venezuela, meaning others. So Iraq has been striving to meet its output under the target, but they're still going around it. So anyway, India's companies are having some problems. Now, we're rolling off to Japan. Here we go. Japan is now looking at petroleum industries calling on utilities to keep using oil-powered plants. Here's why. Solar, wind, all of the renewables cannot hold in a grid that is not capable of holding it. Battery is not there yet, and so they're saying, hey, wait a minute, please keep your oil-based power in standby. Here's the problem that's in this article, and that is power companies based off of oil need to have enough money in order to keep the cash flow going to keep that plant going. So you can't have your green and kill the oil at the same time. Okay.
No, it's killing 2 birds with 1 stone, literally.
Yeah, they're killing everything. Here we go. Here's the fun one, Michael. China imports oil doctored to skirt U.S. sanctions on Venezuela. Spoofing and doping have a new meaning. We have been having fun on this. We've been tracking the Venezuelan. They're parking off of the Iraq boats. Tankers were sitting off Venezuela going, we're not Iranian, we're not Iraq. So anyway, that's called spoofing when they kill the radio on their way out. Doping is where they add additives into the mix so that they can mix it into a heavy versus low-end crude. There's some real serious nuggets in here. So not only do you get into the crossing the line and sanctions, you're messing up the markets. You're trying to do all this. So spoofing and doping, I never thought I'd hear that going on in the oil tanker world there, man. A couple of them are doping is the oil additive with chemical additives changing its name in the paperwork so it can be sold as a wholly different type of crude without its trace of Venezuelan roots. Man, this reminds me of the old days with the folks trying to do moonshining and running. This is almost just like that.
Carolina moonshiners, baby, just running, stripping it of where it's from. I love it.
Oh, absolutely. And this is where NASCAR was born. So are we going to see now racing large large tankers. Anyway, we're going to keep following this story, Michael, as it keeps going around. And
that was good.
I'm sorry, you got to have a little fun with our job.
No, you got to. It's been a busy week, Stu. You've rightly deserved a hall pass we're about to give out at the end of the show. So thank you. Your job this week is done. You can relax. The frequent flyer miles you put in is unbelievable. We really appreciate all of the international news desk stuff via the world's greatest website, www.energynewsbeat.com. Couple things on the U.S. shale side. Let's just cover crude and natural gas stocks right now because they both dropped today because of MLK Day on Monday. Remember, guys, natural gas stocks drew 187 BCF. It's part of the reason why we saw about 0.5% or about 1 full percentage point off that natural gas top line price. Analysts expected 197 draw, so just a little bit smaller than what was expected. Couple things on the crude oil side. Crude oil stocks build 4.4 million barrels. Remember, on Tuesday we got API's recommendation of 2.56, 4 million barrels. So it comes in a little higher. It's part of the reason why you saw crude oil retreat heavy early in the morning and then sort of rise later in the afternoon session. Mostly because that right there was a little bit bigger of a build than was expected. On the production side, we'd say flat at a million barrels, though you're going to hear from David. He don't think that number is even legit, so maybe we'll stop covering it. The other two numbers I really like to look at, though, is percent utilization, refinery utilization, 82.5 percentage points for the entire country. The key is East Coast. It's up 4 percentage points week over week, which is good to see because they're the ones that are lagging. New York's been mostly locked down. East Coast, most people live over on the East Coast. Good to see that refinery utilization number pick up. On the rig count side, huge builds last week. Canada only up 11 rigs. They're currently doing 174. U.S. plus 5, 378 rigs. DJ picks up 2. Permian actually picks up 4. Eagle Ford draws a couple, so that kind of balances out there. Last thing before we go over to David here, Schlumberger, they're up about 8, about a whole percentage point. Mixed bag in terms of revenue. Earnings per share only fell 43. I say only because they were hit hard. They're now losing their one-step business. Earnings per share fell 43.5 percentage points. 22 cents per share. It's actually beat analyst expectations at 17 cents a share. Revenue came in $5.532 billion, which is a decrease of 32.7 percentage points from the same period last year. But it did beat analyst expectations of $5.25 billion. They did issue an interesting guidance. I'm kind of still sifting through all that stuff. I mean, I think Schlumberger people, in a world that is very in service providers becoming less and less, companies like Schlumberger, Halliburton, and Baker Hughes are going to absorb that business. They're going to be around. So I think you're going to, as you're seeing a consolidation going on in the E&P space, you pretty much have already seen a consolidation in the oil field service stuff. I think Schlumberger coming in a little better than what analysts expect is probably the reason why you're seeing them pop a little bit. But we'll get a full report to you next week. Stu, did we miss anything today?
No, we were wiped out. You've done a great job. We've been busy.
Awesome. Well, let's kick it over to David. Well, thanks first for David for coming on the show. We're really excited to have you. If you're in oil and gas, you don't know who DRW is, go just Google him. You'll find out who he is very quickly. There's no introduction needed. The funny part is when we have you on the show, I really was hoping to discuss the extraction coming out of bankruptcy, and that is now like the 6th biggest news story since I think we've talked on Tuesday. So there's some federal stuff that happened, and I kind of want to just first off tee you up. What do you think of Biden's actions? There was one thing, he rescinded the Keystone Pipeline, which is kind of a news story stuff, but then he also did some stuff with federal permitting, and I kind of wanted to get your take on both of them and how you see some of this playing forward.
Yeah, so I want to touch on Keystone first. I think that the key to take away from Keystone was that it was a unilateral, non-discussed executive action. So Canada wasn't aware of it. Now, what I would say is in terms of global oil demand, I'm not sure that the Keystone Pipeline was necessary for any reasonable foreseeable future. Yes, Canada could grow, but we have a totally different price environment than we did. So to me, again, the Keystone was a little bit of a wooden nickel that Biden is trying to communicate to his followers that I am executing, but I don't know that it's truly going to impact. And so I would also say to my Canadian friends, you get what you paid for. And I know you might not have liked Trump, but policy is more important than personality. And now we have to deal with Biden, which tees us up with the second part of it, which was the federal action yesterday with the executive orders to basically take a 60-day moratorium. And what that means is the Interior can delegate the responsibilities of the Department of the Interior to BLM field offices to help them accelerate federal permits. Now, federal permits are very complicated to get. They're an unbelievably thick document. They take 9+ months. And every oil and gas company has been aware that with Elizabeth Warren, when it looked like she could be the candidate, everyone accelerated their federal permitting. And so any company that has any federal acreage went absolutely bonkers and has years and years of
I was reading that yesterday. It's just permit stacking is what it sounded like.
It's permit stacking. And so, of course, permits have a 2-year window and then a 2-year moratorium. But the important thing is that the action taken yesterday has nothing to do with stopping oil and gas right now, but you can message it as a stopping oil and gas. So they withdrew the delegation of authority and basically said, we're going to take the next 60 days to evaluate. Now, what oil and gas companies are going to be worried about is that we're going to see tighter regulations. I don't think there's a doubt about that. Now, I've been very strongly against the industry's flaring practice. I think flaring reflects bad planning. And so I think they're going to tackle flaring. I think they're going to tackle methane. And quite frankly, the operating environment, which is already more stringent on federal acreage, it's simply going to look like Colorado. And so yeah, are there some wild card risks? And we could talk about that in future shows. Yeah, there's some ways he could shut down the industry directly, but this executive order is not that. And so I'm taking a calm pause, but it was certainly interesting that Biden is coming in and undoing 4 years of Trump with the stroke of 11 pens.
Yeah. So along that note, we've covered flaring. We're with you on that. Flaring is just an unnecessary practice right now. The problem is we've just signed with the Keystone Pipeline. You can't get pipelines built anymore. So do you see a way around that? Do you see maybe the administration giving in if they want to tackle flaring? I mean, right? You got to just put this in pipe somewhere.
So I'm gonna be the midstream guys are gonna hate me for this. I apologize, but the U.S. If you go back to the Rystad energy model and some of the blogs that Michael and Stu you've read, going back to September of 2019, I suggested the U.S. had actually already peaked oil production. That was in September of 2019. It was capital constraints. It was bad balance sheets. It was debt, but we'd also stopped gaining productivity per lateral foot, and we were making up for our growth by lengthening wells. Well, it was clear to me in September of 19 that wasn't going to happen, and from November to March, pre-COVID, the U.S. actually declined production. Now, why is that important? Pipelines are built because midstream companies need to allocate new capital to get fixed returns. But when you decline production, all of the pipe capacity that you're finding that there's a tremendous amount of pipes in the United States that simply aren't full. So I bifurcate a little bit what's going on in the Marcellus because there's just so much gas that they can't use it all in the Northeast, and so it needs to get exported. We've seen 11 BCF a day of exports. We've seen Henry Hub differentials blow out. But in terms of oil and associated gas, which is really what flaring is about, right, the infrastructure has the capacity, and the U.S. never again will produce 12.8 million barrels a day. I would argue it likely doesn't produce 11 million barrels a day. We are on decline, and therefore there will be expanded capacity. So companies just need to be better at planning. And then once they do that, flaring can be managed a lot more effectively.
Interesting.
You bring up all great points about pipelines in the world. At Nord Stream 2, we want to bring you back on with all the problems going on with the Russians and Germans and everything else on that one. But tell us about China. What are your thoughts on China coming around the corner?
Okay, so I'm giving a speech now. I can't take the trademark on this. It was actually a friend of mine who coined it. But hindsight is 2020. And I remember giving speeches in January and February of last year, and I was looking at the data because there was this worry. And what I was very confused by was oil was $63 January 3rd, the day after we assassinated an Iranian general. And it looked like the year was setting up really well. But between the beginning of January and the end of January, China started locking down for this virus that they said was killing 45 people a day. Now, this is a 1.3 billion person country. 45 was not a thing. And I said, this is not a virus. Don't worry about it. And yet oil traded down $12 a barrel while the S&P traded up almost 5%. So there was something like, well, if world oil demand is dropping because we don't have like the products being made, shouldn't that mean the S&P is going up? So what's going on in the oil market that doesn't make any sense? That's how I looked at it. Clearly the numbers from China, I know this is a surprise, but they were lying. And so and I'll give Mark Crisano some credit for this. But my belief right now is, so this week, the U.S. Pompeo came out and declared that what China was doing was genocide. We didn't call Syria genocide. So that's number one. Number two, I think there's real questions about whether it's a consumer-led or just a manufacturing-led recovery in Asia that has led to all the optimism that like the world is back. And so I think that Asia and China in particular is announcing these lockdowns, because they can scare the US, right? We already locked down. So they're terrifying us so that we lock down again. I think that would be a horrible mistake. But number two, their economy is not as strong, and you can lie about numbers and fudge numbers, but they need to be able to point to a lockdown in Q1 during this lunar celebration, which is the largest migration of people in any country anywhere in the world. And by pointing to that in Q1, they can say, well, yeah, our GDP didn't meet expectations, but that's because it's a lockdown. Don't worry, we're ripping. Because China still has some real issues with their currency and trade and the trade war with the United States. And so that will be interesting to see. I'm not buying their lockdowns because the reality is coronavirus just does not have a fatality rate that we know now that justifies locking down the world again. And so we got to get back to life, protect the vulnerable, get vaccinations out there, and then like, let's get going. So that's the take on China.
Well, Cuomo tweeted we're not locking down, so I'm safe. I'm taking coverage in that.
Yeah, I agree. I do think, I mean, again, to tie to China, last year in January, they shut down 3 million barrels a day of demand. So they were 13 million barrels going in. 3 million barrels a day drove oil price from 62 to 50. And so 3 million is a real number, but the world is kind of running at a 92 to 93 supply and a 95 to 96 demand. And I think as the vaccine rolls out, and quite frankly, it's just not on the media. Did you know that yesterday 4,500 Americans died of this thing, and it's not even on the news? That would be 58% of the run rate of average deaths in the country at 7,800 a day. 4,500 died, and no one is talking about it. So, we've moved on, and therefore I do think that there's a strong case that demand can come back. I just don't know where the consumers are going to get money.
Yeah, and before we let you go here, I want to circle back to this extraction stuff here, and I think it's a fair, I think what I just find interesting is we knew extraction after they couldn't find a buyer and bankruptcy was going to come back. I find it interesting that the Kimmeridge guys are now running that board over there. That's a little interesting note. But in your email, and if you're not subscribed to Hot Take of the Day at Substack.com, do it right now. It's probably some of the best in-depth stuff you're going to get on a daily drip basis. Do it right now like your life depends on it. But you kind of dive into a little more about the overall risk that Colorado operators had. You talk maybe there's some little M&A. Give us, you can talk extraction, but talk a little Colorado. Speaking of these regulations, it's going to hurt us here, man.
Oh, it absolutely is. And when you look back to Proposition 112 in 2018 that the industry spent around $30 million to defeat, at that time they were trying to push a 2,500-foot setback. And if you haven't been to Denver, the Wattenberg field is all around Greeley, Denver, North Denver. And you couldn't be within 2,500 feet of a structure in a relatively urban and urban to rural environment. That basically means all the surface use is gone. So in essence, it was a backdoor way to ban it. The industry came in, spent $30 million, and everyone voted against it in the oil producing segments of our country. So Weld County was like 90% against it. Aspen, which already has a 120-mile setback to wells, they were quite concerned. And same with Boulder and same with Denver. What ended up happening was Polis came in and immediately after being defeated passed Senate Bill 181, which effectively reconstituted the COGCC and changed their mandate. And just in November, they unanimously passed 2,000-foot setbacks, which has the same impact to Proposition 112. Now, will there be takings lawsuits as were threatened? Most likely. But Colorado, because of the operating environment and quite frankly, the urban and the very left-leaning blue state that we are now, it's starting to look more like California. That's a huge risk. I've said for a long time, I think this basin needs to be a Lord of the Rings, one operator to rule them all. Chevron bought Noble, Oxy bought Anadarko. You have PDC as the outstanding large one. Extraction came out of bankruptcy. Bonanza Creek is trying to buy High Point, which is something we can talk about next week. And we need to see consolidation because you just can't have risk of setbacks and have to have lobbyists and legal and everything. We need one company to own the entire basin. So my view is Extraction gets rolled up. I don't think their assets are pretty urban. They're too small to manage here, and they'll roll into some company and go away over the next year would be my bet.
Yeah, my day job is dealing a lot with some of this stuff, some of these regulations that are rolling on, and actually having to find all this data. Newsflash: nobody knows what these regulations are. That's the scary part that even shocks me, is we're not even quite sure how we need to go about implementing these, not implementing, but abiding by these rules, because they're very level of effort. They're very just burden of proof. There's not much, it needs to be X, Y, and Z.
Yeah, and honestly, you look at an Oxy or a Chevron, those are the two best positioned companies to be the basin consolidator because they have the scope and the scale and they can move dollars across multiple basins to react to politics. Very clearly, we learned that having an office in Denver did not change the politics. And I think that that's the overarching theme in 2021. Our industry needs to do a better job advocating for the importance of reliable, clean, affordable energy, both for us and for the world. But we've been saying it and yelling it from the top of our lungs, and no one is listening. And so I think this is the year with the volatility. The U.S. producers need to basically shut down their operations, go very, very slow, and let prices rise because we bring supply off the market so that oil goes to 60, 65, 70, gas goes to $3.50, $4, and the consumers are the ones yelling because very clearly the voters matter and industry and business does not.
Guys, you can follow DRW, Hot Take of the Day, on LinkedIn, DRW. You can also subscribe to his Substack. Check him out on the website, hottakeoftheday.com. We really appreciate you joining us, David. We're definitely going to have you back. We're probably going to make this some sort of Friday routine. But for Stuart Turley, I'm Michael Tanner. Guys, we're going to let you get out of here. Finish up your day. You can tell your boss you can get a hall pass and go home early. Thank you guys for checking us out. We will see you on Monday for another show.